Silver didn't just fall, it broke the kind of rules traders quietly rely on to sleep at night. In one session, February, silver futures went from above $114 a troy ounce to a settlement near $78 and change. That is a 31% drop in a single day, the second worst day on record by several tallies. And it didn't take months, not weeks. In 48 hours, the metal that had just been celebrating triple digits erased roughly a third of its value on the screen. They said this couldn't happen anymore. Not in a modern, liquid, institutionally traded market. Not in something as widely followed as precious metals. Yet it happened anyway, and it happened so fast that most explanations arrived after the damage was already done. That is the first clue. When the story comes late, the mechanism usually started earlier. The strange part is what came next. The narrative that flooded feeds was simple. Bubble popped, mania ended, nothing to see here. But the tape was saying something else entirely, because crashes like that are not just about price, they are about collateral. They are about who was forced to sell, who could keep selling, and who had the balance sheet to wait for the smoke to clear. Here's the claim that sounds impossible until you look at the mechanics. A move this violent often reads less like the end of a bull market and more like the moment the market purges leverage so the trend can continue with stronger hands. That's not optimism. That's pattern. And once you see it, the silver massacre stops looking like random chaos and starts looking like a very familiar transfer. Institutions already know how this works. They track margin schedules, open interest, volatility indices, and the plumbing between paper claims and physical inventory. Most people just see a red candle and a headline. What I'm about to walk through changes that perspective, because the details of this crash point to a bullish truth hiding inside a bearish moment. Welcome to the Signal Report, where we decode what matters before it becomes the story everyone repeats. If you like analysis that stays calm, uses numbers, and follows the trail of incentives, you're in the right place. And if you want to be part of the community, drop a comment with where you're watching from, because the global map of viewers often reveals something about how different markets feel the same event. Now, what actually happened? Silver entered late January 2026 in a state that can only be described as stretched. Prices had surged above $100 an ounce, a level that feels surreal if your reference point is the decades where silver lived in the teens and 20s. Volatility was elevated, headlines were loud, and leveraged exposure was everywhere. When a market reaches that kind of altitude, it becomes less about new buyers and more about the stability of the financing that keeps existing positions alive. On COMEX, one standard silver futures contract represents 5,000 ounces. At prices above $100, that's more than $500,000 of notional value per contract. Futures traders do not post that full amount. They post margin, a good faith deposit that allows control of a large position with a fraction of the cash. That is efficient when volatility is normal. It is dangerous when volatility changes regime. Then the floor moved. On Friday, January 31st, February silver futures, after closing the prior day above 114, settled near 78.29. Think about that compression. A market that often moves in relatively modest daily ranges, suddenly repriced by an amount that, in calmer periods, would represent an entire year of movement. It is forced liquidation meeting thin liquidity. And it wasn't isolated. Gold, too, saw an unusually sharp decline in the same window. When multiple related markets crack together, it often points to a shared mechanism: collateral constraints. The central mystery is this: if silver was simply a speculative bubble, why did the break have the signature of a margin event? And why did some institutional players appear positioned to benefit from the chaos rather than surprised by it? To answer that, you have to step back and remember that silver has always been two markets at once. There is the physical metal, used by industry, stored in vaults, moved in bars. Then there is the paper representation, traded through futures, options, and derivatives, where the volume of claims can dwarf the amount of metal that could actually change hands. In calm times, those two worlds line up closely enough that people treat the price as reality. In extreme times, the two worlds separate, and that separation is the signal. Here's where it gets interesting. It's cash. If a participant has to raise cash by the close, they sell whatever is liquid, even if they still like the asset. That's why liquidation events often hit the most tradable instruments first. Futures and large funds can become the outlet valve. Physical holders often can't or won't respond with the same speed. That mismatch creates dislocation. We've seen versions of this movie before. In 1980, silver's price became a cultural event. The run was violent, the narrative was loud, and then the reversal was brutal. The result was not just lower prices, it was a lesson written into exchange rulebooks. When leverage grows too large, the system responds by changing the terms of leverage. When that happens, price can move faster than fundamentals, not because fundamentals vanished, but because financing did. In 2011, silver staged another dramatic ascent, pushing toward $50. And then it broke with a sequence that still makes traders wince. A series of margin increases hit the market in rapid order. The story at the time was that volatility demanded it. The effect was that leveraged longs had to post more collateral or sell. Many sold. The crash did not prove silver was worthless. It proved that leveraged positioning can be fragile when the rules of the game tighten. There's also an older parallel that matters psychologically. After major commodity spikes, the most violent down days often occur near the point where the crowd believes the move is permanent. The reason is structural. When everyone is leaning the same way, there is no cushion of natural buyers on the first break. The only buyers are those willing to take the other side when fear is maximal, and those buyers demand a discount. Now in 2026, the pattern repeats with modern scale and modern speed. In January, silver spikes into triple digits. Then in the span of days, it collapses by roughly a third. After the plunge, margin requirements are raised. Historically, that sequence matters. The market runs hot, collateral rules adjust, liquidation accelerates, and then a new equilibrium forms with different ownership. This is where the players enter the story. One of the clearest signals in this crash was that not everyone was on the wrong side. In China, a trading firm called Zhongkai Futures had built a significant short position in silver. Reports described exposure equivalent to about 484 tons, worth over $1.5 billion notional. And as silver fell, the firm reportedly netted more than $500 million in profit. That's not a retail narrative, that is a professional positioning narrative. Why does that matter? Because it reveals that the crash was not purely a spontaneous stampede. There were entities prepared for downside, willing to press it, and able to hold through volatility. And when you combine a large, prepared short with a market loaded with leveraged longs, you get a textbook setup. The break triggers margin stress. Margin stress triggers selling. Selling feeds the break, and the break rewards the short. Zoom out one level further, and you see another layer of institutional behavior. Exchanges are not neutral observers. They are risk managers. Their job is to make sure the clearing system survives extreme moves. When volatility jumps, exchanges raise margin to protect the system. That protection is rational. The side effect is predictable. Raising margin into a falling market increases the pressure on leveraged holders and can amplify the move. After the historic plunge, CME raised margin requirements on COMEX precious metals futures. For silver, widely circulated numbers show the margin for non-heightened risk profiles rising from about 11% to 15% of contract value, with heightened risk profiles moving higher as well. Translate that into lived experience. If the contract is controlling 5,000 ounces and the price is high, a margin increase can mean tens of thousands of dollars more in collateral per contract. If a trader has multiple contracts, the required cash can jump in a way that forces immediate action. This is the mechanism most people miss. Price fell because the cost of holding positions rose into a volatility spike. The market was already trembling, and then the collateral floor was raised, and volatility did spike. The CME Silver CVOL Index, a measure derived from options that reflects forward-looking risk expectations, printed near 98.77. When implied volatility approaches triple digits, the options market is effectively screaming that price movement is no longer a footnote. It is the main event. That environment punishes leverage. It rewards liquidity, and it forces a reset. Now let's make the execution simple with an analogy that doesn't insult your intelligence. Imagine a crowded theater where everyone bought a ticket with a credit card, not cash. As long as the show is calm, nobody notices the financing. Then a small fire alarm rings. The theater manager suddenly tells everyone they must pay the full ticket price in cash to stay seated. The crowd doesn't leave because they dislike the show. They leave because they don't have cash in their pockets. The stampede is created by terms changing, not by taste changing. Now we get to the dislocation, the part no one is discussing carefully enough. Futures prices reflect the marginal transaction in a leveraged, financially settled arena. Physical silver reflects availability, transportation, vault constraints, and the willingness of holders to part with metal. Those two can diverge, and when they do, the divergence itself becomes information. Consider the physical baseline. London Vault data showed holdings in the tens of thousands of tons with end-of-year figures, around 27,818 tons at the end of December 2025. That is an immense stockpile on paper. But the existence of a large number in a report does not mean all of that metal is ready to meet any kind of immediate surge in demand. Much of it is allocated, committed, or simply not for sale at spot. In a stressed market, what matters is what can move at the margin. Now set that against the paper flow. Futures markets can see turnover that dwarfs physical movement. Positions can be created and destroyed with keystrokes. When forced selling hits that environment, the screen price can overshoot to the downside, even if physical holders are not participating in the same way. That is the dislocation. Paper says collapse. Physical says constraint, and the gap cannot persist forever. There's also a geographic element. Western benchmark pricing often reflects COMEX and London liquidity, while Asian markets can express their own tightness or looseness through local premiums, different investor bases, and different regulatory timing. When a large actor in one region is aggressively short, and leveraged longs in another region are funding positions through the same global dollar liquidity conditions, the shock can travel across time zones like a relay. One market closes with stress, another opens with it. This is why the crash can be bullish. A bull market ends when demand collapses and supply overwhelms it. A bull market pauses violently when leverage collapses and supply is dumped temporarily by forced sellers. Those are different. The first is a change in reality. The second is a change in ownership. Look at the clues. The move happened with extreme speed. It coincided with margin changes. It produced extraordinary volatility readings. And it occurred in a market that had attracted speculative interest at triple-digit prices. That combination is exactly what you would expect when an overheated market needs to cleanse leverage, not necessarily when the underlying thesis evaporates. Let's ground this with numbers, because numbers remove the fog. First, the crash itself. A 31% single-day drop from above 114 to about 78.29. Second, the implied volatility, around 98.77 on the CVOL index, a level that signals extraordinary uncertainty and forced repricing of options. Third, the margin shift. Silver collateral requirements moving from roughly 11% to 15% for many traders, with higher tiers moving even further. And fourth, the institutional profit, a reported gain north of $500 million, tied to a short exposure equivalent to roughly 484 tons. Those are not random facts. They are a chain. A leverage market rises quickly. A large actor positions for reversal. Price breaks and volatility explodes. The exchange raises the cost of leverage. Forced liquidation accelerates the move. The prepared short profits. The long side gets transferred from weak hands to whoever can fund the position under the new rules. But the data shows something else entirely, and it's subtle. After an event like this, the market's sensitivity changes. In the immediate aftermath, every rally attempt is tested. Every dip is watched. Participants who survived become conservative. That conservatism reduces leverage. Reduced leverage reduces the fuel for another immediate crash. In other words, the system becomes sturdier right after it feels the least sturdy. Now, if that is the mechanism, what does it mean going forward? Historically, when silver experiences a liquidation event of this magnitude, the next phase depends on whether the post-crash environment stabilizes. If volatility remains elevated and margin stays high, the market may chop and rebuild with lower leverage and more cautious positioning. If volatility compresses and liquidity returns, the market can rebound sharply because the same leverage that was purged on the way down is no longer pressing price lower, and fresh buyers can enter without competing against a wave of forced sellers. There are a few scenarios worth watching, and notice none of this requires prediction. It requires pattern recognition. In a conservative scenario, silver forms a base below the prior peak. Volatility drifts down, and the market spends time digesting. The tell would be steadier daily ranges, declining implied volatility, and fewer abrupt mechanical drops that look like forced selling. In a moderate scenario, silver rebounds as quickly as it fell, not because the world changed overnight, but because the market had overshot due to liquidation. The tell would be strong up days accompanied by a calming options market, where implied volatility starts falling even as price rises, signaling that the rebound is becoming less fragile. In a more aggressive scenario, the rebound becomes a second leg higher later in the year, driven by renewed demand and the memory of scarcity. The tell would be persistent tightness indicators, such as futures curves that refuse to relax, physical channels that show ongoing premiums, and institutional participation that suggests the market is being reaccumulated rather than abandoned. What is worth monitoring in any scenario are the indicators that reveal the plumbing, margin announcements, volatility indices, like CVOL, open interest trends, and the relationship between futures pricing and the ability to source metal without delay. Those are the dials that control how far and how fast silver can move. Now, let's talk about the divide, because this is where most narratives fail. In every major market event, there are two groups. The first group experiences price as a surprise. They react to the move and try to explain it after the fact. The second group watches the conditions that make the move possible. They track leverage, they track collateral, they track positioning. They are not smarter in some mystical way. They are simply paying attention to the machinery. The wealth gap is often an information gap. Institutions move first because they can. They have the systems to see stress building, the capital to survive volatility, and the mandate to exploit dislocations. Retail moves last, not because retail is incapable, but because retail is usually trained to watch headlines instead of plumbing. Silver Massacre is a perfect example. If you only saw a 31% crash, you saw destruction. If you also saw margin rising from 11 to 15%, you saw forced selling. If you saw implied volatility near 99, you saw panic priced in. If you saw a major short in Asia reportedly netting over $500 million, you saw that someone understood the setup before the crowd did. And that's why the crash can be bullish. Because once forced liquidation ends, what remains is a market with fewer fragile positions. The next buyer does not have to fight the same cascade of margin calls. The next rally, if it comes, is built on a sturdier base and clearer risk terms. Before we wrap, there's one more layer that ties everything together, because the market didn't just move, it changed its terms. In the days after the drop, the collateral math became unavoidable. If margin rises from roughly 11% to 15%, the same exposure suddenly needs about 36% more cash. That is not a subtle change. Funds that run tight risk budgets often respond the same way. They cut exposure, not because they've abandoned a thesis, but because their mandate forces them to reduce volatility. That's also why the crash can look worse on a chart than it feels in the underlying ecosystem. Paper claims can be liquidated instantly. Physical supply chains cannot. Industrial users don't cancel long-term procurement because a futures contract settled lower on a Friday. Fabricators and mints don't suddenly become indifferent to silver's role in conductors, contacts, and coatings. The economic reality doesn't turn on a dime, but leverage does. So the screen price can overshoot, and overshoots create the very conditions that allow the market to rebuild. If you want to understand whether the reset is complete, watch for the signs that forced selling has faded. One sign is volatility collapsing from extreme levels, because when CVOL and similar measures fall, options makers stop charging panic premiums. Another sign is that rallies stop being sold immediately, suggesting the urgent need for cash has passed. A third sign is open interest stabilizing instead of falling in a straight line, because collapsing open interest often signals liquidation rather than thoughtful reallocation. And finally, watch the behavior of the institutions that thrive in dislocations. When a firm can reportedly build exposure equivalent to hundreds of tons and walk away with over $500 million in profits, it tells you that sophisticated players are treating silver as a strategic battlefield, not a hobby. Those players don't disappear after a crash. They adapt. They reprice. They look for the next asymmetry. None of this claims silver will move in a straight line from here. Silver never does. It is famous for punishing certainty on both sides. What the pattern suggests is simpler. A crash that is driven by collateral and liquidation is often a purge, and purges are how markets make room for the next phase. And when you stop confusing those two, the market starts making more sense. So the bullish interpretation isn't that pain is good, it's that pain had a job to do. It squeezed out the positions that depended on cheap financing and calm volatility. It forced the market to reveal where liquidity was real and where it was borrowed. And it reminded everyone that in silver, the most important signal is rarely the headline number on the screen. It's the structure underneath it, and whether that structure just became stronger. That is why the crash was bullish. This is the signal report, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. And the real question isn't whether silver will stay volatile. The question is whether you'll recognize the difference between a market breaking and a market resetting before the next move reveals it.